The most violent rallies tend to happen in bear cycles, and the most violent shakeouts tend to happen in bull cycles. You've had a bear market for 3.5 years that has decimated the valuations of these things. When everybody's asking questions, talking about, invest in miners equals lose your money, end of story, period. Okay, well, guess what, folks? Mining and the commodity sector has always been a cyclical arena.
Over the last few months, we've unashamedly focused on gold miners, silver miners, and cryptocurrencies. Today, we're also going to branch out slightly and look at some of Eric's other areas of interest within the mining sector. A lot of them are for the same reasons, and a lot of these are companies which also look to be on their knees, totally unloved, in fact, hated in many cases. And as a contrarian investor, he therefore has taken an interest in those and will outline a few of those areas in the next few minutes. Welcome everyone to Investing in the Minefield, and this week we're going to be looking at how to broaden your horizons in the minefield, because up to now we've been mainly talking about gold, silver, the precious metals, and the junior miners around them, plus obviously some forays into the crypto space. But this week we want to spread our wings and look at the broader mining sector, where some of the issues that we've seen in gold and silver junior miners have persisted elsewhere, but just the basic thesis in some other areas. So once again, I welcome Eric to talk about this space.
Thanks so much, Roger. I appreciate you having me on again.
So we're going to probably talk about a few names. So I'm going to go very early on and say, obviously, this is for educational and entertainment and engagement purposes. This is not investment advice. Do your own research and have your own reasons and goals for investing. But today we're going to look a little bit broader because you don't just specialize in those one or two areas. You actually look across these sort of junior miners in a lot of other metals as well. Could you maybe just start off just by highlighting what other areas you have been looking at and you actually do enjoy investing in that are not just the gold and silver space that we've talked about before?
I like molybdenum, for example. Very interesting metal that is tough to secure, late stage projects or producers. My lithium exposure is limited, and it's probably going to be something that I take half of whatever I get off to get my principal risk, hopefully at a swing up, and then we'll see what happens. I'll keep a little bit on there. But copper, nickel, vanadium, gold, silver, those are some of my top absolute metals. But for those of you that are new, I would absolutely, at least initially, right now, in terms of boosting allocations in this area and or initiating allocations in the mining area, I would start with gold and silver miners. That is where the bulk of the juice is going to begin. So I would just say, just as a caveat, I really like the gold and silver mining stocks, head and shoulders above the rest in terms of a long-term core strategy of a portfolio makeup in the miners. However, there are other metals that are very intriguing to me, and I've also built positions during the bear cycle and built pretty darn big ones to the point where, some of the smaller juniors have gotten so cheap. We're never going to see these valuations again, I don't think. This could be the largest bull cycle that we've ever seen in history in metals and mining stocks going forward. Why do I say that? Well, because you've had tremendous underinvestment since, as far as I've gone back in this sector, which is over 20 years, early 2000s. The amount of money that has been put in to all these different metals to find new mines, find new supply. I really do like nickel going forward. Virtually every concoction that you see with any sort of electric vehicle combination, how much cobalt, how much lithium, how much nickel, copper, all this stuff. Nickel seems to be in virtually every single mixture and component. There's a large component of nickel that's in there. And when you look out, nickel's been smashed the last 12 months. And a lot of that seems to have come from Indonesia, where they've got a lot of dirty mines and they're not implementing anything in terms of, clean up your air. They just wanted to get that out there. They flooded the market. So nickel is very interesting. Copper is extremely interesting. Copper's held a bid, close to $4 a pound. And at $4 a pound, when, you look back 10, 20, 30 years, copper was buck and a half, $2, and now three and a half, $4. It was, over a four handle before it had this recent decline. And everything that I look at for forecasts in terms of this apex of which metals are going to have the demand cycle going up and the supply cycle coming down, where you're going to hit an apex and be at, you're going to be at a negative amount in the market that's available for sale, which typically leads to rising prices, like we saw in lithium, for example. I'm not a huge lithium guy, but I believe that lithium does have its merits. It's harder to make money in lithium companies because there are so many of them. But a lot of them, if you remember, the reason why you had so many of them formed in the last 3 years, 2 to 3 years, is because the lithium price went up fivefold back in 22. And so what happens? Greed. People start to go stake. They start to go put investment dollars into lithium companies. You saw, like at Thacker's Pass with Lithium Americas, GM put in a ton of money. Other car companies, other entities are starting to throw money into getting exposure to lithium. But I was never extremely positioned in lithium because I thought it got too crowded. Now on the lithium side, with the pullback that we've seen over the last 9 to 12 months, many of the lithium stocks have been kind of smashed, down 50% or more. So I've been taking a look back again at lithium, but the copper story also is one of these, and I don't remember the exact amount, but the level of pounds of copper that you need for every electric vehicle is extraordinary. They're much heavier than a normal fossil fuel gas generated car. We are way behind the curve and the clock is ticking. Every different metal that we've mentioned, copper, nickel, I haven't even talked about the critical metals or the rare earths, and even graphite and other things that are necessitous in the EVs. I don't care if the EV theme is slowing down or it was a flash in the pan. There are many, many other needs for these metals, and there has been underinvestment in exploration. Number one, exploration has been terrible. An average mine, from when you end up finding, say, new gold in Nevada, that turns into this sprawling, huge, high-grade ore body that's going to be a big mine of the future, minimum 10 years to start producing. So this backdrop that we're talking about with some of the ones that I like, those are underinvested in areas. That is a problem.
Sounds like, in summary, basically what we've got is, as we know, these are all the sort of areas which are going to be ultimately supplying to the electricity stroke sustainability themes, whether we agree with them or not. It's happening, but there's a massive, massive demand. But ironically, because of that whole same feeling that we need to move that way, there's been a massive underinvestment in the sort of dirty end of this market that we need to become the clean end of this market. So you've got this massive imbalance between future demand and current investment, and therefore current supply, and then also obviously future supply as well, as you say, with this 10-year lag. And so that's going to create some very, very big imbalances. There will be that nervousness that things can get out of hand. So you look at this and go, till 2050 and maybe further, this is an amazing imbalance story. All these things should be bid. But as lithium showed us, in the short term, you can still do your nuts if you get into something where the emotions have got a little bit too aggressive. And people still, I know we've moved away in the last 6 months, but people still worry about a recession where these stocks have a high beta. How do people deal with this? Because a lot of people have been wanting to go into this, but been waiting for either some of these prices to come down or for this recession, which hasn't happened, in order they can get into something for the next 20 years. How do people play that?
Well, I'm going to use a word that's a little less of a swear word. What the hell are you waiting for? You've had a bear market for 3.5 years that has decimated the valuations of these things. When everybody's asking questions, talking about, oh, invest in miners equals lose your money, end of story, period. Okay, well, guess what, folks? Mining and the commodity sector has always been a cyclical arena. So the key for that, Roger, I think, is that you need to be putting money to work during what is an extremity. The best way to make money at it is like right now, where you've already got some of the metals that are at pretty decent prices. But if we get any spikes on those, then like you said, what ends up happening, the motivation and the only motivation to catch up, to get production, exploration, production, and development of these assets that are necessitous for us to run the world. Don't forget, this isn't just about EVs. This is about the ability for us to even have a computer to talk on, a phone. Do you like your refrigerator? What are you waiting for? You've got a bear market, at least I can say from my perspective. I've been in this space for a while. I believe this is the worst bear cycle that I've seen, particularly when you gauge it based on the smallest of the mining stocks. So what's the downside? That's my question.
When I look at things like the European natural resource sector, so it's not all miners, there's some other stuff in there. And it's called the SXPP, the Stock 600 Basic Resources. And it's been sort of sitting on this support of what looks a bit like a head and shoulders potential top for God knows how long, quite a long time. And this has been the thing, is that last year it looked like it was going to break and it tested that neckline and then, oh, no recession. So it bounced again. I think that for a lot of people, it's like, oh, but what if we had that recession? This thing could fall 30, 40%. And then people going, well, yes, we should get in now. But for a lot of people, they'll be thinking, no, I can't go through that 30, 40% drawdown if we go into a recession first on these stocks, which are generally industrial cyclicals. And it's a hard mentality for people like myself.
Fair enough. But I hope to hell you don't own NVIDIA, and I hope to hell you don't own a lot of the S&P either. So I would rather have exposure in things like a cyclical sector that's already in a bear market, that's been in a bear market for a long period of time, than be in, these few areas in the market that everybody seems to own. So you're not immune in those other areas would be my first point. Secondly, that's also why I would stress the theme, if you're going to play the miners and or the metals, focus first on gold and focus second on silver. You can worry about recession and all this shit all you want. And it does matter. It does matter in terms of how different areas of the market are going to perform.
Most people can conceptualize gold futures, silver futures, obviously ETFs, junior miners on both silver and gold. When people think about copper, again, there's not a very good ETF, but there's people look at the futures market, and obviously there's the behemoths in the copper world. So people can get their heads around that. But when you talk about these other areas, you talked about, your rare earths, your critical metals, your vanadiums, nickels and cobalts, what are people doing in that space? Or how do you do it? Because there's not like a big dashboard that everyone can look at that has these names on it.
Yeah, like for example, in lithium, I do own a couple of the smaller ones that I know that are really well backed by groups that have deep pockets, and they're not going to let those things go under, even though their valuations have come down in the last 6 months along with the lithium price. I've actually looked at starting to buy a little bit of those. But where I've kept it simple in lithium is in recent weeks, Lithium Americas, Albemarle, these are companies that are very large lithium producers already, and they are blue chips in the space. But Lithium Americas, for example, I was just buying long-term call options and stock itself in the fives and around $6 USD. But I'm keeping it simple because
What sort of time span do you have on those? These long dated call options. What's your sort of usual expiry on those?
My philosophy is always buy at or in the money price, strike prices, and pretty much most times I go out as far as I can, as far as there are listings on it, and I'll pay the premium. Not always, because for example, with lithium, lithium isn't a core thesis in my investment portfolio. I think it's been oversold. So, I bought some options. I bought some positions that I would also have stop loss limits on, by the way. But on the options and or on the equities themselves, I'm hoping that that's a 2 to 4 month trade, because if they bounce from an oversold condition, and I can make 50, 100% on the stock and then make, 200% on the options, I'll put some money in there, not a ton. I'm more focused on situations like, for example, that are still under the radar. Vanadium is one that you mentioned because I've mentioned it here with you before. There's very few opportunities to invest in quality vanadium companies, and a lot of listeners may not know what vanadium is. Vanadium to me is as or more important than lithium, because vanadium is the clean battery metal of the future for industrial scale batteries, not just electric vehicles. A company that, as a prerequisite, I am the largest shareholder in, Phenom Resources, which is a Canadian, Vancouver-based company, PHNM, and then you add an F to that, and that's the US OTC symbol. I recently invested in a small private placement. Rob McEwen, who's a well-known guy that we just had on here, he's the second largest shareholder. And we've got a great shareholder base of people that are not in this for, waiting a week or a month or have some pressure on our timeline. We just know that vanadium, which is at an all-time low right now, is going to have some sort of a cyclicality to it again. And we'll wait for that, because Phenom's got the largest, highest grade at surface vanadium deposit in North America, and it's in Nevada. The stock is trading at about 30 cents Canadian, 35 cents Canadian right now today. And I'm down on that one too. So by the way, people, if you look at it, you can actually get it cheaper than I have all this stock, and I've been in it for years. So it's the biggest position I've ever had in my career, in my life, in anything. Paul Colley, CEO of Phenom Resources, was contacted last year by a Japanese company that had cracked the code on developing a solid state vanadium battery. We ended up being approached by them saying that they need to secure vanadium. They're thinking out, 10, 20, 30 years. And there's no vanadium out there after like 27, 28. Like, there's just not a lot of vanadium, not to mention the fact that you've got 73 to 4% of all global vanadium production is controlled in China and Russia. Yet in the United States, we have some ample vanadium. In Canada, there are many potential vanadium mines, but our governments, they're completely behind the curve. So this is a security risk in the United States. If you've got Russia and China that are producing over 2/3 of this particular metal, and they're not really sharing it very well with us. This is an area that I think has tremendous potential for clean energy on an industrial scale. If you want just a producer, you can look at Largo. They do a lot of their production out of Brazil. The stock is very suppressed. Vanadium's not exactly the talk of the town right now, but that's when you want to start to look at, assets that are cyclical and get the whole thing about the recession out of your mind, because I understand your point. People looking at, well, what if there's a recession? Well, then you got to wait a little longer. Either get some conviction and believe in something, or just stay out of the market.
It sounds like people have to have something of almost like a project finance infrastructure mentality, because some of these things that you're talking about are going to accrue their returns over quite a significant time. But sentiment-wise, it's obviously very negative now, so you can get in. But when you're in, you've probably got to think about holding these things. They're not going to go up 10x in the next few weeks. They're going to be something which will build and build and build as this effectively a very, very long-term megatrend plays out over certainly years. And for some people, it'll probably be a decade plus long investment opportunity.
The most violent rallies tend to happen in bear cycles, and the most violent shakeouts tend to happen in bull cycles. They happen, and they scare the crap out of anybody who was, going with the trend in the right direction. You mentioned that this could be a super cycle, or you'd have to wait years for these returns. I don't know if that's really going to be the case. I think that if we get a secular move in the metals and in some of the metals, then yes, you're going to want to hold on to these for years. But even just with a mid-level cyclical bull market from these points right now, so call it a year and a half, 2 years. If you hold something for 1.5 to 2.5 years, and you can have anywhere from 5 to 50x on some of the more speculative names, it's pretty damn good. It's not so easy to find this in utilities, even oil and gas, these days, or in, even in tech. The miners have the ability to have a lot of juice, and to have a lot of juice quickly, and especially a lot of that juice can come in that first, 6 to 12 months, even if it is something that is a super cycle. So I will only hang on to some of my positions in the miners, where I'm looking out 5 to 10 years. If the evidence along the way is showing me that it's good for me to hold some of these positions. But just like Rick Rule said on that interview, when we talked about uranium, he said the easy money's already been made.
I guess what a lot of people are thinking about is rerun for different reasons of the bull market we had really from the advent of China into WTO in 2001, which apart from the very, very, very large drawdown in 2008-9, effectively carried on till about 2011-12. That was 11 years. And what was great about that is that you had higher prices, but you also had huge volumes because China was hoovering this up. Feels at the moment we've got higher prices, but these companies, because of this underinvestment, have not got the huge volumes which can translate that higher commodity price underlying into the sort of profitability that people were seeing in that leverage period of sort of 2001 to 2012. So I think a lot of people are thinking, rather than playing the squeezes and the sort of short-term moves, is there the opportunity to think long-term? Some people's retirement funds could be started to be built here, and they might not be retiring for 20, 25 years, but this is a trend, the long-term trend that people can hopefully access.
Get some on the books, get a position, and just sit tight. There will be opportunities along the way to reduce risk, like earlier in a cycle, and then hold, the bulk of, call it the majority, where you can hold this stuff as long as you like. And that's what I tend to do in these type of situations. So hopefully, people that are making bets now, you can get, all of your principal risk out within 12 months, potentially, 6 to 18 months, call it, and triple your money, take out a third, or if you want to be more conservative, sell half at a double, and then be patient with the rest of it, because you have no risks. You don't necessarily have the downside because you've already taken that out.
When you're talking about buying these stocks and really thinking about across all these various different sectors, are you mainly buying listed US and listed Canadian stocks and some OTC? Because you talk about other jurisdictions. You have talked about Australia in the past. You talk about South America quite a lot. Are you getting your exposure through US listed companies, or are they the foreign listings in the US of companies that are actually primarily overseas?
I do not invest any money in Australia. Australia has a very robust natural resources and mining sector and market for them. There is a part of the culture of the investment community in Australia that bothers me. And the reason it bothers me is because they are not afraid of diluting the piss out of their share structures. Like, you will see so many penny stocks in the gold and silver and the metals area, and they've got 300 to 700 million shares outstanding. Whereas at least in Canada and the US, You'll see that from time to time, but it's an anomaly. People are much more cognizant of how much they dilute the capital structure. It's actually the number one thing that I look at. How many shares do you have out? How many are in the float? And have you done rollbacks? It's very common in Australia. Generally speaking, the headquarters of the mining companies that I own are in Canada. But because they know that they've got a market 10 times bigger right below their border, they obviously want to have listings in the US. But the reason that I focus on Canadian miners is because the TSXV, if I recall correctly, and I believe I'm in the ballpark, raises the most capital for metals and mining projects in the world every year. And it's been happening for about 20 years or more. It might be slightly more. So that's pretty extraordinary. You don't see a lot of the mining companies that are headquartered in the US because they just have so many more pieces of rules and regulation to make it more expensive to list on the Amex or even just to go on the OTC. It's better to list in Canada on the CSE or the TSXV and then get an OTC QB or QX listing in the US. That's where the bulk of my money goes. Now, I do buy a lot of the mining stocks that I'm in for, whether it's swing trades or long-term investments. I do keep more money in my US brokerage accounts that I control. Because if I have to sell a private placement that I invested in years ago, I'm still paying 1.5% to sell something versus like if I buy it in, on a US online exchange, it's a fraction of that. So I mix that up, but I don't invest directly in Australia. If I have any exposure, and I think I do, to like one or two, one's a uranium project and one's a gold project in Australia, it's because they're owned by Canadian miners, not an Australian miner. So the answer to your question is most of it, I would say if it's not in private, companies or whatever that aren't listed yet, it's probably somewhere in the ballpark of, 60-40, 60% being in my US online brokerage accounts and 40% being in my Canadian brokerage accounts because I invested directly in a private placement.
Well, it's a large spread of different underlying resources and obviously companies. So we'll have to keep a few of those on our radar over the next couple of months just to see not just how the gold and silver guys are doing, but also how vanadium, lithium, cobalt, all these other areas are doing as well.
Yep.
And hopefully get some updates towards the end of this period on how they're doing too.
Yeah, and there are certain ones that will come up that I've had an affinity for a period of time. For example, I found a unique company called Zenyatta Ventures that had discovered a hydrothermal, very different hydrometallurgical graphite deposit, and it was a new discovery. It ended up putting me on the radar in Canada, but graphite, I don't have any exposure to graphite right now.
Well, great to speak to you again, Eric, and I'll catch up with you next week.
Thank you, sir. Have a good one.
So as you heard there, not only is it gold and silver, but he's looking at lithium, he looks at cobalt, vanadium, and other interesting parts of that metals and mining space. As always, many of these are very, very small cap, quite hard to get exposure in. Certainly if you're trying to build big positions, it can be quite hard. Which is why, again, he recommends that methodology of building your positions over time. And then if you get lucky enough for one of these to take off very quickly, take your capital back off the table and then run it for the long term. Because there's obviously that little bit of a balancing act between those short-term opportunities when you get these big high beta moves versus some of these being very, very long-term themes that we all expect to play out over 20 to 30 years. They're not mutually exclusive. You can trade into and trade out of and take profits whilst holding some core long-term positions in these stocks. And over the next couple of months, we'll continue to look at some of these less well-known areas of the metals and mining space.